I know that you want to do better in your career as a businessman, as an investor, but what's really important to understand as you're moving forward is that investments and careers and businesses don't always move in a straight line going up. Sometimes they take time to develop. That's why I have been going through this exercise of building a small business. My name is Michael Santos. I learned how to build wealth or success or prosperity even though I was in prison for 26 years. And I'm very passionate about wanting to communicate the lessons that I learned with other people. And I'm absolutely convinced that there are many lessons that we can learn from small business. If you watch the earlier episodes in this playlist about how to build a business and how understanding how to build a business will make you a better investor, you will understand what I am trying to convey right here. This is the profit and loss statement, the income statement, for a very simple fictional business that we created to use as a case study. It's Michael's Hot Dogs. We sold 800 hot dogs during the course of a year for $1 a hot dog, and through all of that investment, we learned that after a year's worth of work, we actually lost $10 of our capital. We lost $15 if we take into account our interest. So this business has not worked out so well, just as many businesses don't work out so well when they get started. But as investors, we are always having to look at a business from the lens of what's going to come. What's going to happen in the months, in the years, in the decades to come. Those are the lessons that I learned that helped me to become more successful, and we can absolutely apply them to a small business like this one that showed revenues of $800. We ended up with a loss of $15. Now, that loss included non-cash charge, one non-cash charge called a depreciation expense, which we see right here. Right? We remember that depreciation expense relates to the fixed assets that we purchased, it's 7 hot dog stands that are depreciating every year by 1/5. Right? A $300 hot dog stand is going to last about 5 years, so every year we are depreciating it by $60. And that's what we've done here in this first year. We've depreciated $60, but we didn't really spend that money. We just set it aside. But at the end of the day, even though we only set it aside, our profit and loss statement shows us that we've actually lost money. And as investors, it's important for us to determine how are we going to respond when we learn that our financial statements show that we have lost money. So we need to think about that. We need to process that. And we need to remember our intentions when we set out. We weren't after a get-rich-quick scheme. We were after the goal of building a sustainable business, a business that would grow. I mean, a business is like the story of the tortoise and the hare. Slow and steady always wins the race. And when I laid out the business plan to investors, remember, I was very clear about us being on a 5-year plan. So we can take what we learned during the first year and use that knowledge as we continue to execute the business plan. Remember, it's all about visualize success, the best possible outcome, about creating a plan and then putting priorities in place and executing the plan every single day. And so over the next year, based on what we learned during the first year, we can project how our hot dog stand is going to grow in subsequent years. And we are going to use some assumptions here, so we've actually worked through those years. And we will go ahead and do that by starting some more coursework here. So we've agreed that instead of taking any money out of the business, we are going to continue to feed this business by growing it, because we are absolutely convinced after our first years of operation that we can grow this business to become more efficient and more successful if we grow. And we'll be able to generate more efficiencies if we sell more hot dogs. So we start thinking about what can we do. And instead of taking cash out, we are going to use any cash that we generate to acquire more hot dog stands so that we can sell more hot dogs. So we're going to assume that we can charge an additional 5 cents every year for every hot dog that we sell. We're also going to assume that every year we are going to sell an additional 5% more hot dogs than we sold the previous year, because more people were becoming aware of our work. They loved our hot dogs, and we are going to execute our plan flawlessly with discipline and commitment. And in so doing, we will have new financial statements that show the following results in 5 years. And I'm going to take the time to write them out here for you so that you can see exactly how our plan worked out by just executing the plan every single day. So let's take a look at where we were in year 1 of Michael's Hot Dogs. Year 1, we had 1 hot dog stand, right? How am I going to do this? Year 2, so that goes over there. Year 2, we invested more capital. We ended up building a bigger hot dog stand operation every single year. In year 1, we had 1 hot dog stand. We sold 800 hot dogs. 800. We brought in $800 in revenues, right? Year 2, what did we do? We continued to grow, but now we had 2 hot dog stands, okay? And we remember that our sales grew by 5%, and we also increased prices by 5%. So in total, each of those hot dog stands sold 840 hot dogs, but that equals 1,680 hot dogs for a total revenues, because now we're selling them for $1.05. So in year 2, we had total revenues of $1,764. Year 3, things are looking up. We continue to expand. So in year 3, we added another hot dog stand, right? So we go to year 3. Now we've got 3 stands, and each stand is now selling more. They're selling the hot dogs for more money, $1.10, and we sold a total of 2,646 hot dogs. So that increased our revenues, 2,646 hot dogs, which increased our revenues that year, or that period, to $2,911. Okay? Now let's go to year 4, continuing to execute our plan. We have 4 stands, okay? And that means those 4 stands are selling hot dogs at another 5% bump in price, and each stand is selling 926 hot dogs. How's that looking? So each stand selling 926, that leaves us to selling 3,704 hot dogs at a price of $1.15, which brings us $4,260. Wow, that is just awful writing here. I'm not so good at writing vertically. But we can see that our business is continuing to grow. And finally, we get to year 5, and we're even more optimistic. We don't only add 1 stand, we actually add 3 additional stands. So year 5, we added 3 stands, plus 3 equals 7 stands. Each hot dog stand is selling 972 hot dogs for $1.20 each. So that results in us selling a total of 6,807 hot dogs at $1.20, which brings us total revenues of $8,168. You see me looking behind you. I've got this clicker in my hand, so I'm clicking along a PowerPoint. I didn't remember all these numbers in my head. But at the end of the day, this is what our numbers look like. And we can now take our financial statement and see how we have done. Remember, we started year 1 with only $800 worth of revenues from selling 800 hot dogs. But by executing our plan, our financial statement is showing significant progress. By scaling the business, opening more hot dog stands, we have been able to really increase efficiencies. And our income statement and our balance sheet show the growth of what we have done. By the end of year 5, with 7 hot dog stands, after our costs of goods sold of relatively small, that's $800,169 revenues, right? We can look at a very simple revenue statement or income statement after the end of 5 years. We see that we had $8,168 in revenues. We had $1,702 in costs of goods sold. Oops, shoot. This is going to be 8168 under revenues. COGS, which is really just our inventory and so on like that, is going to be $1,702. So we will put $1,702 there on our very sloppy income statement, and we will show that we also have depreciation for each one of the fixed assets that we have, the hot dog stands, right? And we have 7 hot dog stands. So in year 1, we only recorded $60 to depreciate that one hot dog stand, but by year 7, when we have added significantly more hot dog stands, we're recording $400 depreciation expense. That's going to be $420, okay, in expenses. So depreciation expenses are continuing. We also had to account for labor expenses on our income statement. And we're going to just say that the labor market was good and we didn't have to raise prices too much. So we had $530 in year 1, but by year 5, we spent $3,710 in labor. These are all dollars, by the way, and that's our labor expense. Okay, and we're continuing to work through our model, and when we consider all of those numbers, we can see that our financial statement shows that the business really did quite well. $8,168 in revenues minus $1,700 in cost of goods sold minus $420 in depreciation expenses minus $3,720 in labor expenses. That leaves us with a profit, gross profit, of $2,335 in profit. Okay? It's a gross profit. But look at what that is in the profit margins. That's 28.6% profit. Really phenomenal considering that in year 1, we only had 1.3% profit margins. Here we have 28.6% profit margins. So we have really grown our business's efficiency. We're still paying the $25 interest on our debt every year. So that's going to come off of this number. But at the end of the day, we can see that although we lost $15 in year 1, if I work through those numbers right there, what you would see is that in year 2, we actually made a profit of $139. In year 3, we made a profit of $454. In year 4, we made a profit of $949. And in year 5, we made a profit of $2,311 after we took off our $25 in interest. Leaves us with $2,311. That is adjusted for pennies on the total. I rounded up. So when we take all of this into consideration, we can look at the business from the lens of an investor. Okay? And you may remember what our investors initially put up. They only put up $500 in cash to purchase 500 shares. We also took in $250 in debt from a lender. And by executing our plan year over year, our financial statements show that we're now earning a profit of $2,311. But let's remember that $2,311. Let's remember that, and now we're going to go and take a look at, well, what happens? Because remember I told you, although we didn't have to pay taxes in the first year, now that we've been making profits, we are, and we're budgeting 35% tax on $2,311 in revenues. So we've got to take that into account as well. But even when we take that tax into account, we end up seeing that we did really, really well. Because $2,311 at 35% tax, that only amounts to a total tax bill of, what is that? I said tax bill is going to equal, let's see if I can see my eyes there, $809 in tax, right? 809 in tax, which gives us, now we've got our net profit of about $1,502. Okay, or remember there's a total of 1,500 shares outstanding in this corporation. So you look at all those totals, you can get a much bigger picture of how our small business did for investors. The initial investor put only $500 in to buy 500 shares at $1 a share, and now the company is earning $1,500 in a single year. That doesn't take into account what it earned in all of the previous years, nor does it take into account the cash flow. So in the next video, because we've kind of come to the end here, I want to keep these in 15-minute segments, I want to get into cash flow and show how a small business, an operating small business, can really generate benefits for an investor, but we also have to be able to compare and contrast an equity investor with a debt investor. The more we understand about all of these metrics, the better we are going to position ourselves to understand how to make business decisions as we move forward. If you are an individual who is young and wants to get involved in business, these are some of the broad concepts that you should be understanding. If you're an individual who has gone through struggle and you need to be thinking about what you're going to do with the rest of your life, the more you understand about small business, the better positioned you are going to be to make calculated decisions of what you are going to do today to put you on a pathway to success in the months and years ahead. This is especially relevant, I think, for any young person who is contemplating taking on massive amounts of student loan debt to go into a 4-year college program that may not yield the type of income that you need to get a good return on investment. Understand a little bit more about small business, and you are going to understand how you can make better decisions that will influence your prospects for success. These are the concepts that not only got me through 26 years in prison, more importantly, put me on a path to build millions of dollars worth of assets, and I know you can use these same concepts to build more success in your life. I am Michael Santos. Hope that you're subscribing to the program because I'm doing my best to try and show you the strategies and the tactics that got me into a life of prosperity. But it's really important to realize you've got to develop this basic understanding of business in order to become a better investor. At least that's what I believe. That's what worked for me. That's what I want to share with you.